Are you in your 20s and hesitant to invest? Don't be that way. In fact, if you're still young, you're in a better position to invest for a happy and prosperous retirement than anyone else. Avoiding stocks and investing at that age can potentially be detrimental to your long-term financial stability. Hey guys, welcome to our channel, FinanceX. In today's video, we are going to talk about the top 5 absolute best ETFs. Let's see what we have for you to discuss. If you want to find out more about it, then stay with us until the end of the video. Also, before we start the video, don't forget to hit like, subscribe to our channel, and ring the bell icon for more amazing videos. And let's get started. Even if you don't have a lot of investable cash at the moment, even a small sum saved and invested early on can pay off handsomely in the long term, both literally and metaphorically. Time is the most important concept in investing because of compound interest, which Albert Einstein named the 8th wonder of the universe. And if you're young, you not only have the luxury of time, but also the luxury of being extremely aggressive in your investment strategy early on. That's because you'll have plenty of time to make up for a failed high-risk, high-reward venture with future earnings. Are you still apprehensive about picking individual stocks? Don't worry. There are a plethora of different exchange-traded funds, or ETFs, out there that can provide you with broad exposure to specific sectors, styles, indexes, and/or risk-reward profiles to fit your investing objectives, and they're usually quite low cost. As a result, if you're in your 20s, you should look for ETFs that hold aggressive growth firms and/or smaller stocks with the potential for a big upside over a longer period of time. Here are 5 ETFs to consider, each with the potential for significant long-term returns. Invesco QQQ Trust. Let's begin with the Invesco QQQ Trust, which is one of the most fundamental components of any growth investor's portfolio, QQQ 1.72%. The QQQ is akin to investing in the broader market of large-cap growth stocks because it attempts to emulate the performance of the technology-heavy NASDAQ 100. Given the long-term trends in cloud computing, artificial intelligence, e-commerce, and the Internet of Things, the NASDAQ isn't such an awful place to be. Because many of its stocks are in these large tech themes, the QQQ has a very solid long-term prognosis. The QQQ has gained about 13% this year, while the S&P 500 has lost 0.2%. The difference is most likely due to the QQQ's large 43.85% technology weighing versus the S&P's lesser 22.6% technology weighing. Many investors believe that as companies adjust to remote work, e-commerce, telemedicine, and other computer-based solutions, the coronavirus pandemic will accelerate the aforementioned tech developments. Despite the coronavirus, technology has been a significant outperformer this year. Over the last decade or so, large-cap technology has been the best place to be, and it appears like it will continue to grow over the next decade as well. In fact, the QQQ's biggest risk may not be the stocks that make up the index, but the possibility of it becoming so successful that the government intervenes with antitrust laws. Vanguard Information Technology Index Fund ETF shares. Let's imagine you wanted to go all in on technology, and the QQQ is extremely tech-heavy compared to the broader market. Is there a low-cost exchange-traded fund for that? There is, without a doubt. With an 87.56% allocation to technology equities, the Vanguard Information Technology Index Fund ETF shares, VGT 2.21%, provides broad exposure to large, mid-cap, and smaller companies nearly entirely in the technology sector. While some of the stocks in this ETF are technically categorized as financial or industrial equities, there is almost certainly a considerable overlap between technology and these industries. So if you want to go all in on IT and avoid peripheral industries like consumer discretionary firms or communication stocks, the VGT could be the option for you. What's the better option? It has a very low expense ratio of 0.10%. One thing to bear in mind is that Apple and Microsoft are strongly weighed in this ETF, accounting for around 37% of the whole ETF. Given each company's long-term outperformance, this isn't inherently a bad thing, but it does create some single-stock risk if something goes wrong with these two companies. Vanguard Small Cap Growth Index Fund. Small cap companies have outperformed large cap stocks this year and over the past decade or so, but this is the exception rather than the rule. Small cap stocks outperformed large cap stocks by an average of 2.3% points per year between 1926 and 2006. When multiplied over 20, 30, or 50 years, this might make a significant difference. That makes sense when you consider it. After all, a smaller company has more room to grow than a giant stock, whose growth is constrained by the law of large numbers. Of course, that hasn't been the case for the past decade or two, as the market's largest corporations have appeared to become increasingly powerful. Trends can, however, reverse over time, and given that tiny caps have traditionally outperformed in prior decades, they may do so again. Look no further than Vanguard Small Cap Growth Index Fund, ETF shares, if you're seeking for an underperforming ETF that could make a greater comeback. Growth equities appear to be more interesting than a broad cross-section of small caps or value small caps these days. Thus, I'd recommend the growth-oriented small cap ETF. The VBK, for example, has a 29.76% technology allocation and a 24.75% healthcare exposure. When compared to the Vanguard Small Cap Index Fund ETF shares, which has more exposure to, in my opinion, less attractive long-term sectors like financials and energy, these are both overweight allocations. ARK Innovation ETF. Want anything more aggressive than the above-mentioned tech-based growth ETFs? ARK Innovation ETF, ARKK 6.46%, is an actively managed ETF, which implies that stock selection and allocation decisions are made by managers rather than by an ETF that attempts to simply copy an index. Nonetheless, actively managed ETFs provide traditional ETF features such as tax efficiency, liquidity, and transparency. While this may appear to be the best of both worlds, actively managed ETFs often have a higher expense ratio. That's the situation with ARK, which has a 0.75% expense ratio, which is significantly more than QQQ's 0.20% expenditure ratio. Catherine Wood and her colleagues run ARK, which only invests in distributive, next-generation technology companies that have the potential to disrupt or establish entirely new sectors, regardless of current revenues. They include things like next-generation internet companies, genomics, robotics, cryptocurrencies and finance, 3D printing, mobility as a service, and other futuristic products and services. ARK has totally crushed not only the overall market, but even the aforementioned technology indexes above, thanks to its recent excitement for disruptive firms. ARK is up a stunning 27.5% year-to-date. This can be ascribed in part to the performance of Tesla, which accounts for 11.7% of the ETF's portfolio. Other full favorites like Square, a fintech business, and Illumina, a genomics company, are among ARK's top holdings. Of course, with such a large potential gain comes the risk of extreme volatility and large losses over a similar time span. But wait, there's more. You're in your 20s, right? You're capable of dealing with this adversity. And because you're a fool, you've got the long-term perspective you'll need to ride out the ups and downs and hold on for large long-term returns. Schwab Emerging Markets Equity ETF. You should also embrace your inner adventurer as a young person. This entails allocating some of your assets to emerging international markets. After all, why allocate investments to the fastest-growing nations and countries if you're interested in fast-growing companies? I recommend the Schwab Emerging Markets Equity ETF for exposure to emerging markets. The SCHE provides investors with broad exposure to some of the greatest firms in China, India, Taiwan, and other emerging countries, with an expense ratio of only 0.11%, aiming to match the total return of the FTSE Emerging Markets Index. Alibaba and Tencent are two of the largest interests, along with Taiwan Semiconductor Manufacturing, a leading Taiwanese semiconductor foundry. While the index is down almost 10% on the year, this isn't always the case, as U.S. stocks have recently outperformed developing market stocks. Furthermore, these countries are rising at a greater rate than the United States as a whole. In 2019, China's GDP increased by 6.1%, India's by 4.2%, and Taiwan's by 2.7%, all of which were higher than the United States' 2.3% growth. This means that while the companies in this ETF may be more risky due to their location in emerging nations, they also have more potential for growth. U.S.-China trade tensions are one current key risk to consider, since they may have contributed to some of this ETF's recent underperformance. With nearly 2 billion inhabitants, many of whom are just entering the middle class, China appears ready to grow by leaps and bounds in the long run. Assuming you're prepared to take on this risk for a portion of your portfolio, the SCHE might be an excellent way for any 20-something to get top-quality emerging market exposure. And this is it for today, guys. What are your thoughts on today's video? Share with us in the comments below. Also, don't forget to hit like, subscribe to our channel, and ring the bell icon so you don't miss any of our latest updates. And thank you for watching.